Hey there, it's Dustin Miller with Fair Realty, and today I was looking at the Financial Post and noticed some news that the International Monetary Fund, the IMF, rated Canada as the most overvalued housing market in the world. So it uses a ratio of house prices to rents, which is a typical measure of house price valuation, and it showed that Canada was 85% above the global mean. Um, so what does this mean? That we could actually be facing a housing market bubble, as some people tend to suggest. And the IMF is calling for the Canadian government to abolish or reduce the CMHC home insurance, which is insurance to the big banks in case of defaults on loans. The Canadian government will act as a lender of last resort in the case of a massive downturn and people not being able to meet their mortgage obligations. So Canada typically relies on this macro-prudential regulation supervision of financial system to address this frothy housing market. So that means lower loan-to-value ratios, stricter mortgage underwriting standards, limits on second home financing, higher counter-cyclical capital buffers for mortgage lending, higher permanent capital charges for mortgages, and restrictions on the use of pension funds for down payments on home purchases. Moreover, the higher the gap between an official interest rates and the higher rates people get locked into on their mortgage as a result of these macroprudential restrictions, the more room there is for regulatory arbitrage. And so what I mean by regulatory arbitrage is, let's say, for example, if loan-to-value ratios are reduced and down payments on home purchases are higher, households may have an incentive to borrow from friends or family or from banks in the form of personal unsecured loans to finance a down payment on a new property. So Canada's new housing bubble may not be about to burst just yet, because the forces feeding them, especially easy money and the need to hedge against inflation, these are still fully operative. Buying property is one of the best ways to protect yourself from inflation. So moreover, the Canadian banking system has bigger capital buffers than it did in the past, enabling them to absorb losses from correction in home prices. And in Canada, we also see that households have that household equity in homes is greater than it was during the U.S. subprime mortgage bubble, where many people had little to no equity in their homes. But the higher home prices rise, the further they will fall, and the greater the collateral economic and financial damage will be when this bubble deflates. In Canada, we also have full recourse mortgages or loans, which allow the seizure of household income to enforce payment of mortgage obligations. So when that happens, you would tend to see private consumption plummet as debt payments and eventually rising interest rates crowd out discretionary spending. Either way, the result is going to be the same, more recession and stagnation.